Hey, Bulls and Bears, we are back with another dose of economic reality. And we've got a lot of good stuff to get into today. First of all, I'm leaning back further than usual. You know that little lever on the side of your chair, if you have an office chair, the one that stops the chair from reclining? Well, that broke. So now I have to sit up like this, like my last video, and get really close. Or I sit back like this. So I think I'd rather sit back like this here. Anyways, let's go ahead and get into it. We got a lot to talk about here, a lot to catch up on as usual, as we try to navigate this very, very unusual, difficult, treacherous economic climate here and financial situation where we have record levels of household debt, interest rates that have doubled over the past year and a half, prices that are still way too high, banks that are being allowed to loan out a lot more money than they have in deposits, which is not a good thing. When too many people go to pull their money out, that's known as a bank run. And then you have banks that become insolvent. So what's going to happen? Is it going to be a credit crunch? Is it going to be the banks are going to be nationalized? Therefore, the amount of loans that they can give out then at that point will be unlimited because they're going to be backed by the endless money printing. Who knows? I don't know what the plan is, but we need to figure out the best way to navigate it, right? So let's get into some news here that's going to kind of help us see what's happening going forward here and help us plan going forward here. The Fed's top regulator tells Congress SVB, that's Silicon Valley Bank, was textbook mismanagement. Mismanagement. So think about that, mismanagement. It makes it seem like it was all just a big mistake, like they didn't know what they were doing. Oh, we didn't know that we were giving out this many loans. We didn't know that the loans we were giving out were much more than the money we had in deposits. We didn't know. It was just mismanagement. That's all it was. So see, they make these things sound like a mistake, but see, this is what all the banks are doing. So all the banks are mismanaged. The reason Silicon Valley Bank started the banking crisis, so to speak, is because it was in the tech sector. And tech, as we know, has been taking a big hit over the past 3 to 6 months. And of course, we've reported here all the massive numbers of layoffs coming out of tech. So naturally, a tech-based bank like Silicon Valley Bank was a lot of people should have guessed that that was going to be the tip of the first domino to fall, so to speak, this year. I mean, of course, there's other banks that have failed in the past, and some people are saying that the bank didn't even fail. They're just saying it got bought out, which now it did because they got bought out by another bank. But like my analogy that I used a couple reports ago, if you're running a race or you're doing something to try to make it to the finish line and you fall down and you collapse and people have to pick you up and carry you across the finish line, did you succeed or did you fail? Well, I would call that a failure. But Silicon Valley Bank collapsed. They had to be picked up, so to speak, bought out or rescued, and people don't call that a failure. That's a failure in my book, in my opinion, and I think most of you probably feel the same way. So it's interesting, though. The next debate here that's come up, or a recent debate, is the students who did not get their student loans forgiven. All right, so they see all this money being thrown at these billionaires that had more than 250,000 in Silicon Valley Bank. They see the billion upon billions of dollars given to billionaires and corporations and companies, and they say, okay, why can't we get this money for our student loans? Why can't they give the billions over here, but they give it over there? You know what I mean? So it's very interesting how, again, there's choosers, right? They pick the winners, they pick the losers. Who's going to get the money? Who's not going to get the money? It's not an easy thing to figure out, where the money's going to go. And the same thing when it comes to investing, right? So people that bought certain bank stocks after they collapsed um, got rewarded because the banks ultimately got rescued. Look at Credit Suisse, bought out by UBS. They're over there in Switzerland. So pretty crazy times we're headed into, folks. Crazy times are here. I say headed into. Crazy times are here. We've got to stop saying that, right? Let's talk about this. The IMF, that's the International Monetary Fund, warns risk to global financial stability have increased in the wake of banking failures. And they say, quote, uncertainty is high. So did it just increase with the banks failing? Or were the banks destined to fail anyways? right? I think it was foreseeable, and that's why we've been talking about on this channel here for years, that the banks were not survivable in the case of too many people pulling out their funds at once, because the fractional system of loaning money and our method or our system of fake digital money versus something that's physically backed by a commodity such as gold or precious metals or silver. But all these articles here, the IMF and the Fed, all these people, all these so-called experts, they said, oh, it was unforeseen. And now that this bank failed, now the uncertainty is higher. All of a sudden, no one saw this coming. No one saw this coming. And it was just mismanagement. That's all it was. Guys, you see what's going on here? So they're making this sound like just somebody, dropped the ball, so to speak. And that it's not going to happen again. Things are going to be different going forward because the regulators are going to keep an eye on it, make sure this doesn't happen again. Do you really believe that they're going to really stop these banks from doing the same thing that these other banks failed from? Please let me know down below if you think that. Credit crunch could worsen the bank turmoil, and commercial real estate could be the next domino to fall. Yes, commercial real estate is way over leveraged. Some say even worse than residential real estate, where we see still an enormous housing bubble that hasn't deflated that much yet. But let's talk about how bad it could be. Take a listen at some of these numbers here. Over the next 5 years, more than 2.5 trillion, that's trillion with a T, in commercial real estate debt will mature. This is by far more than any 5-year period in history, worse than 2008. Meanwhile, rates have more than doubled, and commercial real estate is only 60 to 70% occupied. You see, since 2020, a lot of work at home situations came up, and a lot of the companies kept the work at home in place. Now, some have called their people back. Not all the companies, obviously, but many of these companies kept the remote work situation. It was actually cheaper than bringing people back to the office. They found out a way to save money. I work for a great company that has allowed me to work at home for several years, and it's a big money saver for the company. They saved $2 million a year lease here in San Diego County by having their people work at home, and they give us perks. They pay for our high-speed internet, for example, because they're saving so much money by having us work at home. Just one example of how companies can save money. So a lot of companies still have remote workers, and some of them may never call the workers back. So 60 to 70% occupancy now. So that means a 30 to 40% vacancy rate for commercial real estate. Not good. And especially when a lot of these companies went out and paid a lot of money because rates were so low. And just like in residential real estate, the lower the interest rates, the more you're able to borrow. And that's what happened to a lot of these commercial landlords. So what's going to happen to the commercial landlords? Are we going to see a big default tsunami in commercial real estate? It's going to be very interesting, to say the least. Now, let's move on here. Separate topic, but still has to do with your budget, finance, the cost of living. Over 3,000 pounds of beef recalled because possible contamination. So there you go. So your hamburgers, your beef, your patties are about ready to get more expensive. Kansas Meatpacking Company has recalled approximately 3,400 pounds of boneless beef chuck product due to possible contamination. Wow, so not good news there if you're looking for lower prices at the grocery store. Also, when it comes to automobiles, some of the lower priced cars, a couple of them are Hyundai and Kia. And if you don't get them stolen, because they're one of the easiest cars to steal, apparently, because a lot of insurance companies were afraid to insure them, and they had to upgrade their systems to prevent theft. And then some insurance companies started insuring the vehicles once again because of the upgrade. But now we've got this. Hyundai and Kia recalls 570,000, over 500,000 vehicles for fire risk. And one of the things they're telling people telling the owners of these cars, park outside, because if your car catches on fire, that way it's not going to catch your garage and therefore catch your house on fire. Not good. Not good. So, people are looking for low price vehicles, obviously, with the high interest rates, with vehicle prices still being very high. And now some of the more affordable vehicles have fire risks, right? So, definitely not good. Expect, the price to go up because people that aren't going to buy Hyundais and Kias now are going to go buy other vehicles likely and make those prices go up because more people are going to be going towards other vehicles and it's going to be more demand for non-Kias and non-Hyundai vehicles. All right, let's talk about the US dollar. The US dollar index is now at about a 7-month low. The 7-month low. De-dollarization is continuing across the globe. We've got countries now going outside of the dollar to trade with one another. Some of them are integrating precious metals. Some of them are trading oil for their national currencies. But outside of the dollar is the phrase of the year here, and it's going to continue. De-dollarization is happening very, very quickly. So not only do we have to worry about the forces of inflation that we've seen over the past few years, with all of the lending, people bidding up prices, shortages, supply chain disruptions. A lot of them have eased, but now we still have in the background de-dollarization and all this new money creation that's going to be very, very inflationary. But if we have a credit crunch, like some are expecting or predicting, then that could be deflationary. That means it's going to be much harder to get a loan. So what's going to happen? Your guess is as good as mine. But please let me know down in the comments what you're doing to get ready for this. I think you've heard my plan here and my strategy. I've said it time and time again. So hopefully you're well. Thanks everybody for tuning in. Please give me a like and help this. I forget to say that one of my readers here, one of my viewers, said, "Hey, why don't you tell people to give you a like? Everybody else says smash the like button. I never say that." Right, I never say that. I try to get my likes to be organic. I don't try to ask people to like it if they don't like it. But maybe you forget. So I guess I should ask people because maybe you just forgot and you like it, but you just forgot. So if you like it, please hit that like button. Don't forget. Appreciate it, guys. People, keep stacking by now. Peace.